Colen, thanks indeed for coming in.
Thanks for the invitation.
Well, a lot of anticipation ahead of this afternoon's decision, and we'll get into their positions in a moment, but perhaps we should start by actually asking, why is a grading for a country so important? What's the big deal about it?
It's very much, if one can dilute a little bit, for example, a consumer going to the bank, asking for finance on a particular asset, depends on the credit score.
Yeah.
Someone who's got a better credit score is going to get prime, at least. Someone with the worst credit score, maybe not the right fit in the sector of the economy, maybe work in the manufacturing side or mining, manufacturing, for example, will get maybe prime plus. So it's about risk assessments. But if you magnify that many times over, you get to a macro level, to a country level. And of course, this is now what's under scrutiny today, Fitch and S&P.
Yeah, so essentially, the worse the downgrade, the higher the cost of borrowing for us.
Absolutely.
So let's just go ahead and take a look at where we stand now as far as these two rating agencies are concerned. I see S&P has us on a BBB minus, Fitch on BBB, and that's the one that analysts are concerned about. Because what do we have? Weak economic growth. We have high unemployment and a forecast of a huge budget deficit for the few years. Does that support a downgrade by Fitch?
Collectively, it does. I think what the rating agencies are looking at right now is GDP growth, or rather the lack of it. One looks at the annual growth figure, for example, and we 1.4% this year, not too much better next year. And we just recently had the release of the seasonally adjusted number for Q3, and we narrowly averted recession, 0.7%. So they've been looking at the key financial stability ratios, your fiscal deficit, your public debt, interest and servicing debt, PSBR, current account deficit. Yeah. These are all referenced against economic growth, against GDP growth. And if we're lacking on GDP growth, those key ratios are going to move against us. In fact, they have moved against us, and I think maybe sufficiently to warrant not just an outlook change, but possibly also a notch downgrade by the agencies today.
When you say a downgrade, I mean, do you see this coming from Fitch?
From Fitch, I think it's probably signalled that already. It's got South Africa on a negative watch. We can't go too much lower. The outlook scale is positive, stable, negative. Yeah. So it signalled last year already a downgrade, I think. So we'd be looking at a lower investment grade rating. Still one notch above where we don't want to be, that junk status that people commonly refer to, or the non-investment grade, as I like to better refer to as. But of course, S&P is the big one, because we're already at the bottom end of the low investment grade rating. If we have one notch cut, we're in a non-investment grade bracket, and then it does matter, because you've got a split rating between S&P and Moody's in particular.
All right, so let's take a look at the other side for a moment. I mean, could there be affirmation of the current status? Because the reason I'm saying is, you look at the positives. Treasury has committed to some prudent spending. We've also seen a very credible Reserve Bank. We've seen them raise interest rates just a few days ago. And then, of course, load shedding has abated. I would imagine these are positives here, Colen.
They are positives, but I think in the scale of what's happened, let's take, for example, the Reserve Bank's leading indicator numbers. Yep. It's been contracting now for 23 consecutive months, almost 2 years, and it's steering, I think, South Africa. In fact, that particular indicator is indicating pretty strongly that South Africa might be in recession. Don't wait for the official numbers. But I think this is the critical issue. It's not. It's a lack of GDP growth. It's the disruptions in the labour market. Yeah. It's the disruptions which the utilities have caused to economic growth. It's fiscal slippage. I think it's being very difficult for government now to cut back on the expenditure side. It's going the other side of the coin, taxes. And we've seen this year a hike in personal income taxes. Next year we can maybe speculate. We've got maybe a hike in VAT. Yeah. But I think collectively we've also got funding pressure coming in. The state-owned enterprises, we're not sure how much eventually Eskom is going to need. SANRAL, the SA Post Office, the list is long. Education needs more funding. The drought needs funding, and of course this is money that we don't have. And where we get it from is going to be critically important.
All right, I've got a few more seconds before I let you go. Let's try and connect what's happening in Sandton at the moment to the ratings agencies. We've seen South Africa and the rest of Africa sitting down with the Chinese. Is there a link? Is there a remedy here?
Absolutely. I think for me, the outcome of this 3-year spending program by China is important. We need to be not just taking commodities out the ground and shipping them out of South Africa, but I think more critically important is beneficiating these commodities. We don't want to be exporting commodities, the raw commodities, and then importing manufacturing goods and services and pressuring our external accounts. So the outcome for me is going to be more interesting in terms of beneficiation, job creation, employment opportunities. We've got a 25.5% unemployment rate. It's too high. We need to work at getting it down. Hopefully the trade pact with China will help.
Colen, Garrow from Lafika Securities, always a pleasure. Thanks indeed.
Thank you.
Well, Airbus says it's studying finance